Ready to turn $100 into $1,000 through trading? Let's cut through the noise and focus on what actually works for beginners. Forget the flashy gurus and complex jargon. You don't need a fortune or a PhD in finance to start. The real secret: build a solid foundation, protect your small account, and use strategies designed for steady growth. Today I'll show you 3 proven approaches: risk management, swing trading, and day trading. No gambling, no get-rich-quick schemes, just real, actionable steps. By the end, you'll have a clear roadmap to grow your trading account the smart way. Let's dive in. The #1 rule in trading: protect your capital. Think of your trading account as the foundation of your financial house. If you lose it, you have nothing left to build with. Every decision you make should be filtered through the lens of capital preservation. Without your capital, you're out of the game, and the market doesn't care how smart or skilled you are if you can't stay in it. Risk management isn't glamorous, but it's what keeps you in the game. It's the invisible shield that protects you from the market's wild swings and unexpected surprises. While others chase quick profits, seasoned traders know that survival is the real victory. The best traders are often the best risk managers. Always use a stop-loss. Set it before you enter any trade. A stop-loss is your safety net, your pre-planned exit if things go wrong. It's not just a number, it's a commitment to discipline. By setting your stop-loss in advance, you're making a promise to yourself to respect your plan, no matter what emotions come up when the market moves. This cuts losses and removes emotion from your decisions. When you let your losses run, you're gambling, not trading. By cutting losses quickly, you free up your capital and your mind to focus on the next opportunity. Remember, every dollar you save from a loss is a dollar you can use to catch the next winner. Stick to the 1% rule. Never risk more than 1% of your account on a single trade. This rule is your lifeline during losing streaks. Even if you hit a rough patch, your account won't be wiped out. It's about staying power, not swinging for the fences. If you have $1,000, risk no more than $10 per trade. It might seem small, but small risks add up to big protection over time. This approach keeps you in the game long enough to learn, adapt, and eventually thrive. Calculate your position size based on your risk. Don't just guess or trade random amounts. Use math to your advantage. Position sizing is the bridge between your risk tolerance and your trading strategy. It's how you make sure that one bad trade doesn't ruin your week or your year. If your stop loss is $2 away from your entry, buy only 5 shares. This way, your maximum loss is capped at $10, perfectly matching your risk plan. It's a simple formula, but it's the backbone of professional trading. Avoid leverage when starting out. Leverage is tempting because it promises bigger gains, but it also brings bigger risks. For new traders, it's like playing with fire. One wrong move and you could lose more than you invested. It magnifies both gains and losses, and can wipe out a small account fast. Many beginners have learned this lesson the hard way. Until you have a proven, consistent strategy, keep leverage at arm's length. Write down your trading plan before you enter a trade: entry, stop loss, and target. A written plan keeps you accountable and focused. It's easy to get swept up in the moment, but your plan is your anchor. Then, follow it without second guessing. Keep a trading journal. Documenting your trades helps you spot patterns in your behavior and your results. Over time, your journal becomes your personal trading coach, showing you what works and what doesn't. After each trade, note what worked and what didn't. Be honest with yourself. Did you follow your plan? Did you let emotions take over? The more you reflect, the faster you'll improve. This is how you improve. Growth in trading comes from self-awareness and constant learning. Every mistake is a lesson, and every win is a chance to reinforce good habits. Never chase losses with revenge trades. It's easy to get emotional after a loss, but doubling down rarely ends well. Revenge trading is a fast track to blowing up your account. If you're upset, step away and reset. Don't overtrade. Sometimes the best trade is no trade at all. Give yourself space to clear your head and come back with a fresh perspective. Wait for high-quality setups, even if it means sitting on your hands. Patience is a trader's secret weapon. The market will always be there tomorrow, but your capital won't if you force trades out of boredom or frustration. Diversify across sectors, not just stocks, to avoid correlation risk. If all your trades are in the same sector, one bad news event can hurt your whole portfolio. Spread your risk so that no single event can take you out. Set realistic expectations. Aim for small, consistent gains. Compounding is your friend. The magic of trading isn't in huge wins, but in steady progress. Over time, small gains snowball into significant results. Your job isn't to win every trade, but to manage risk and let your winners outpace your losers. Even the best traders lose often, but they keep their losses small and let their winners run. That's the real secret to long-term success. Master risk, and you'll outlast most beginners. In the end, trading is a marathon, not a sprint. The traders who survive are the ones who respect risk, learn from their mistakes, and never stop improving. Make risk management your top priority, and you'll give yourself the best chance to succeed. Swing trading is an ideal strategy for beginners, especially if you have a small account and a busy lifestyle. Unlike day trading, which demands constant attention and quick decisions, swing trading is designed to fit around your life, not take it over. You don't need to be glued to your screen all day, watching every tick. Instead, you're looking to capture price moves that play out over several days or even weeks, giving you the flexibility to trade part-time while managing work, school, or family. The beauty of swing trading is that it allows you to plan your trades in advance. You can analyze the market after hours, set your alerts, and let the trades come to you. This approach is less stressful and more manageable for most people, especially if you're just starting out or have other commitments. The key to swing trading success is finding stocks that are in a clear, established trend. Look for stocks that are moving consistently upward or downward, not just chopping sideways. Trends are your friend. They give you the best chance to ride a wave and capture a meaningful move. Once you've identified a trending stock, wait patiently for a pullback to a support level. This is where many traders get impatient, but waiting for the right setup is crucial. A pullback gives you a lower risk entry point, increasing your odds of success. When you see signs of a reversal, like a bullish candlestick pattern or a surge in buying volume, that's your cue to enter the trade. These signals suggest that the pullback is ending, and the trend is likely to resume. To filter out market noise and focus on the most reliable price swings, use daily or 4-hour charts. These time frames help you see the bigger picture and avoid getting caught up in minor fluctuations that don't matter in the long run. Always protect your capital by placing a stop loss just below the support level. This way, if the trade doesn't go your way, your losses are limited, and you can move on to the next opportunity without major setbacks. Set your profit target near the previous high or a logical resistance level. This gives you a clear exit plan and helps you avoid getting greedy or holding on too long. Use simple, effective tools to guide your decisions. Moving averages help you spot the overall trend direction, while volume spikes can confirm the strength of a move. These indicators are easy to use and powerful for swing traders. Support and resistance lines are your roadmap for entries and exits. Mark these levels on your charts so you know exactly where to buy, where to sell, and where to protect yourself. Stock scanners are a huge time saver. They help you quickly filter through thousands of stocks to find the ones that match your criteria, like trending stocks with recent pullbacks, so you can focus your attention where it matters most. Here's a classic swing trade example. Imagine a stock in a strong uptrend that pulls back to its 50-day moving average. A bullish candle forms, signaling buyers are stepping in. This is your entry point. Place your stop just below the moving average to manage risk. Your target is the last high where sellers might step in again. If the price reaches your target, you lock in profits and move on to the next trade. Swing trading lets you grow your account steadily, without the stress and constant pressure of day trading. Plus, you're not limited by the pattern day trader rule, so you can trade at your own pace, even with a small account. With patience, discipline, and a methodical approach, swing trading can be a powerful way to build wealth over time, one trade at a time, and all on your own schedule. Day trading is one of the most fast-paced and dynamic ways to participate in the financial markets. It involves buying and selling stocks, futures, or currencies within the same trading day, aiming to profit from quick price movements. Unlike long-term investing, where you might hold a position for weeks, months, or even years, day traders close out all their trades before the market closes. This means you're constantly watching the markets, looking for opportunities and making decisions in real time. The appeal? The potential to make money quickly, sometimes in just minutes or hours, as prices swing up and down. One of the biggest advantages of day trading is that you don't have to worry about overnight risk. When you close all your positions by the end of the day, you're protected from unexpected news or events that can cause prices to gap up or down while you sleep. This can bring peace of mind, especially in volatile markets. But the challenge is real. Day trading is not for the faint of heart. The markets can be extremely volatile, with prices changing rapidly in seconds. You need to be able to make split-second decisions, often under pressure, and stick to your plan even when emotions run high. It's easy to get caught up in the excitement or panic, which is why discipline is so important. If you're trading stocks in the US with a margin account and your balance is under $25,000, you'll run into the pattern day trader or PDT rule. This rule limits you to just 3-day trades in a rolling 5-day period. It's designed to protect new traders from taking on too much risk, but it can be frustrating if you want to trade more actively. However, there are ways around it. You can use a cash account, which lets you trade as long as you have settled funds, or you can trade futures and forex, which aren't subject to the PDT rule. As a beginner, it's crucial to start with simple, rules-based strategies. Don't try to reinvent the wheel or chase every hot tip you see online. Instead, focus on learning a few proven setups and mastering them. Write down your rules, create a checklist, and review it before every trade. This helps you stay consistent and avoid impulsive decisions. One popular strategy is the opening range breakout. Here's how it works. You watch the price action for the first 30 minutes after the market opens, marking the high and low of that range. Then, you look for a breakout above or below that range to enter a trade. This approach takes advantage of the volatility and momentum that often occur at the start of the trading day, when news and overnight orders are being digested. Always use tight stop losses and keep your position sizes small, especially when you're just starting out. This means you set a maximum amount you're willing to lose on each trade, and you stick to it no matter what. Small positions help you manage risk and keep your emotions in check, so a single bad trade doesn't wipe out your account. Risk management is even more critical in day trading than in other forms of trading. Because you're making more trades and reacting to fast-moving markets, it's easy to let losses pile up if you're not careful. Always know your risk before you enter a trade, and never risk more than a small percentage of your account on any single trade. Protecting your capital is your #1 job. Another key tool for day traders is the VWAP, or volume-weighted average price. This indicator shows the average price a stock has traded at throughout the day, based on both volume and price. Many traders look for opportunities when the price pulls back to VWAP in the direction of the overall trend, using it as a dynamic support or resistance level. Choosing the right broker is also essential. Look for one that offers fast order execution and low fees, since every second and every cent counts when you're trading frequently. Delays or high commissions can eat into your profits and make it harder to succeed. Hotkeys and reliable charting software are must-haves for serious day traders. Hotkeys let you enter and exit trades instantly, without fumbling with your mouse, while good charting tools help you spot patterns and make informed decisions quickly. Set a daily loss limit for yourself. If you hit that limit, stop trading for the day, no exceptions. This rule protects you from emotional decision-making and helps you avoid turning a bad day into a disaster. Before you risk real money, practice in a trading simulator. Simulators let you test your strategies in real market conditions without any financial risk. This is where you can make mistakes, learn from them, and build confidence in your approach. Prove to yourself that you can be consistently profitable on paper before you go live. Track your trades, analyze your results, and only move to real money when you have a proven edge. When you finally start trading with real money, begin with the smallest position sizes possible. The goal is to get comfortable with the emotional side of trading real money, not to make a fortune right away. In the beginning, focus on flawless execution of your strategy, not on making profits. If you can execute your plan consistently, the profits will follow over time. Specialize in just 1 or 2 stocks or markets at first. By focusing your attention, you'll start to recognize their unique patterns, rhythms, and behaviors, which gives you an edge over traders who try to watch everything at once. Day trading isn't for everyone. It's stressful, demanding, and requires a high level of discipline and self-control. You'll face losing streaks, emotional ups and downs, and the constant temptation to break your own rules. If you find the pace too intense or the stress overwhelming, consider swing trading instead. Swing trading involves holding positions for several days or weeks, giving you more time to make decisions and less pressure to act instantly. But if you thrive on action and excitement, day trading can be incredibly rewarding. Just remember to always follow your plan, manage your risk carefully, and treat trading like a real business, not a game. In the end, day trading is a marathon, not a sprint. Consistency, discipline, and patience are what separate successful traders from the rest. Stick to your process, keep learning, and remember, the journey is just as important as the destination. You've learned the essentials: risk management, swing trading, and day trading. There's no one-size-fits-all strategy. Choose what fits your lifestyle and risk tolerance. Practice in a simulator, refine your plan, and start small when you go live. Focus on protecting your capital and executing your plan, not chasing quick riches. Trading is a marathon. Steady progress beats rushing in. Thanks for watching. Like, subscribe, and let me know which strategy you're excited to try.